Okay, hi. We've had a little technical difficulties. I'm
And
Jack.
we still are.
Yes.
And I'm Bill.
And this is the Jack and Bill Show.
Thank you for joining us. I do want to acknowledge one of our viewers who provided a comical comment about an opening act. You know who you are. Unfortunately, we have no spots for musical opening acts, but if we could have an opening act, what about Warren Buffett? Wouldn't that be great? Although I did see where someone paid $4.5 million just to have lunch with the man, so that's a non-starter. But perhaps in the future we can look at that. We've been having a lot of questions from our clients concerning the economy and economic growth, and so that's a subject that we will delve into this afternoon. But let me just give this disclaimer. Neither of us are economists. We're not nerdy enough to be economists.
That's good, Bill.
But Jack, didn't you major in economics in college?
I did.
Most of you, let me just say, most of you do know what economics is, the study of economics. I'll tell you what economics is not. Economics is not a hard science like physics. At best, economics is a soft science like sociology. And the reason for that is because it involves people and people's flawed decision making. So I apologize to all the economists out there who spend their careers studying this, but at best it is a soft science. But it is relevant to investing, and so that's why we do look at economic issues to make investment decisions.
Like today, we had a key economic release today in gross domestic product growth, the GDP number that came out, and we've had some herky-jerky, markets and reactions to these news and news items, and our Federal Reserve is watching this very closely. Last Friday, we talked briefly about how the futures markets were indicating a 71% probability that Jerome Powell and the U.S. Federal Reserve were going to cut the federal funds rate 50 basis points or 0.5% when the FOMC meets the next time, which is the end of this month. And already by the next day, we had other Fed governors chiming in and trying to rein back those kinds of hopes because the low interest rates keep the market propped up. But very quickly, we had some comments from Fed governors, and the Fed futures probabilities indicating that we're more likely going to see 0.25% reduction instead of a 0.5 point cut. So with today's GDP release, the markets were looking for 1.8% growth. That's Q2 or second quarter 2019 over second quarter 2018. We came in very promising with 2.1%. We had expected President Trump to come out and chime in, and he said this was spectacular news in spite of the Fed having wrongly tightened in December of last year and doing quantitative tightening or unwinding their large balance sheet that came about because of the Great Recession that we had. So what do you make of all this, Bill?
Well, I think one thing we need to do is drill down into the numbers just to see where the pockets of strength were in terms of economic growth in the second quarter. We did see some weakness on the trade front, manufacturing, but the strength came from the consumer. So we still see a strong
Absolutely.
U.S. consumer, and that's understandable with unemployment very low, wages increasing, people are spending money. And so that's still supportive of economic growth in the near future.
Yes, that's right. The consumer consumption component of the GDP release showed a 4% year-over-year increase, and the consumer makes up about 70% of the U.S. economy. So where we're headed, the the broad U.S. stock market made new highs today on this news. So we have found ourselves kind of in a Goldilocks situation. Growth is not too fast, it's not too slow, it's just right. And so the stock market is still the only game in town with this release. How do you feel about that, Bill?
It does appear to be that way. Not too hot, not too cold. One concern I do have is with the markets expecting a 50 basis point cut to the Fed funds rate at the next meeting. What happens if the Fed backs off? With this economic growth number, it'd be very difficult for them to cut that deep. And so if we don't get a 50 basis point cut, perhaps it's 25 basis points, but what if they don't cut at all, Jack? What do you think that would do?
The real danger, I think it's baked in right now, we're going to see a quarter of a point cut, which is really what most people feel like we need. But there is some probability, albeit a low probability, that they don't cut at all. That would be, with expectations so high, in my opinion, that would make the markets fall 2 or 3 percentage points, and then everyone would be focused on what's wrong with Jerome Powell and our Federal Reserve.
It'd be a temper tantrum.
That's also true. You know, in today's Wall Street Journal, the headline story here is the European Central Bank is signaling a rate cut and a relaunch of stimulus. So we're looking at Mario Draghi and the ECB starting quantitative easing again in Europe. And so the European economy's not doing quite as well as we are. We've gotten a little disjointed there on the heels of the tax cuts that we had last year. The U.S. economy appears to be a little bit more robust. So to answer your question, if we did get disjointed from what the Europeans are doing and got too strong with our dollar policies, and then the Fed, did not cut, that would be very damaging, I think, at least on a near-term basis.
I would agree with that. But what about those who are talking about the current risk of recession? How would you answer that question, Jack?
Yeah, I would just say with the numbers coming in, I mean, we've had 9 quarters in a row here of economic growth, anywhere from around 1.8% to over 4%. So essentially, 2 to 3% economic growth in a long-dated economic expansion. We are in a long-dated economic expansion, which makes people, ask the question, how much longer can this thing go on? But I think with the tax cuts that we've had, with the Fed signaling rate cuts forthcoming, and then the consumption component of the GDP number, consumers are feeling pretty healthy and pretty strong right now. They like the way Trump has guided, this country economically so far. So I don't see that that there's an imminent risk. I mean, there's some probability in 2020, but maybe more likely 2021. And with the bond market having moved sharply, we've got the housing market, postured for lower interest rates, home builders picking up steam again, and mortgage financing rates going lower, and the prospect for more refinancing. So would you have anything to add to that, Bill?
Well, I think another aspect of this is psychological. And when we're looking at consumption and even investing decisions by businesses, a lot has to do with psychology and how individuals feel. And so right now, we do see a U.S. consumer that feels pretty good. And as long as the U.S. consumer feels pretty good, that U.S. consumer is spending and investing, and likewise businesses are doing the same. So as long as that's the case, we can rock along. But when we see things start to slow down and the consumer starts to feel it, starts to worry, be a little concerned, then that psychological impact can affect consumption and investing decisions. So just another little wrinkle to the mix.
Yeah, that's right on. So I'd just like to say in conclusion, if you have any questions about anything we've stated today, or if you have any questions about some ways to participate in this stock market or this economy that again came out, we're growing at 2.1%. That's not too fast and not too slow, and it's perfect for the Fed to ease at the end of this month 0.25%, and for the U.S. stock market to lead the way in the global economy and keep the party going. If you have any questions, again, feel free to write in and ask that. And and I'd also like to conclude by saying, hey, go Tigers. The LSU Tigers got a new locker room this week that created some controversy, and our New Orleans Saints began mandatory practice today. So my wife Stacy's going to be thrilled about Drew Brees and the boys tossing the ball around. So with that, we wish you a terrific weekend. Happy Friday to you, and keep this thing going.
And we'll see you next Friday, 3:30. Thank you.